Hello, and thanks for joining us again on Investing Fundamentals. I'm Miles McQuillen, Assistant Vice President on the Private Wealth team at GAMCO. During our previous discussions, we've touched on the notion of risk and risk tolerance, but today we are diving into what exactly that means and what it may look like for you. Let's first define what we mean by risk tolerance. It's essentially your ability and willingness to endure fluctuations in the value of your investments. Every investor is unique, and finding where you stand on the risk spectrum is a key step in building a successful investment strategy. So how do you determine your risk tolerance? Let's break it down into a simple process. First, assess your financial goals. Are you saving for a short-term goal like a vacation? Or are you investing for retirement decades down the line? Your time horizon can significantly impact how much risk you can afford to take. Next, evaluate your risk capacity. This involves considering your financial situation, including your income, expenses, and overall net worth. A solid financial foundation can provide a cushion against market volatility. Now, let's talk about the emotional side. How well can you handle the ups and downs of the market without losing sleep? If market swings keep you awake at night, you may want to lean towards a more conservative approach. To that end, your understanding of the market and investment vehicles plays a significant role in determining your risk tolerance. If you're well informed and experienced in financial markets and investing, you may be comfortable with more risk. Now, let's categorize risk tolerance into three profiles: low, medium, and aggressive. If you have a low risk tolerance, you likely prefer stability and are more concerned about preserving your initial investment. Conservative investment options like money market funds, bonds, or blue chip stocks might align well with your goals. For those with a medium risk tolerance, you're comfortable with a moderate level of risk in exchange for potential higher returns. A balanced portfolio with a mix of stocks and bonds might be suitable for you. The 60-40 portfolio, that is 60% stocks, 40% bonds, has been the benchmark allocation for investors over the years. Now, if you have an aggressive risk tolerance, you're willing to take on significant market fluctuations for the potential of higher returns. You might lean towards growth stocks, alternative investments, or even venture into more volatile markets. In conclusion, determining your risk tolerance is not a one-size-fits-all approach. It's about aligning your investments with your financial goals, emotional resilience, and knowledge level. At Gabelli, we work with individuals and carefully consider all these dynamics to align your portfolio with your risk tolerance. Whether you have a low, medium, or aggressive growth appetite, we can work with you to orchestrate the appropriate balance of financial instruments. Thanks for joining us. We always encourage questions and feedback, and see you next week.